All right, what is up, traders? What's up, tycoons? Super excited for today's video. We're going to break down a lot in today's video. We're going to start off here with IWM and also QQQ and break down the chart pattern we have on the QQQ as well as the S&P 500, known as the inverse bump and run. And this is one reason why I'm not overly aggressive shorting the market. Okay, now also, does it make sense to be overly aggressive or overly aggressive longing the market here if you weren't in the rally here, right? So, we did get into the market before the really extremely large rally before last week, and we were able to catch a large amount of this move. We took some profits on those, and now we're waiting for clarity, okay? Patience pays, all right, and cash is a position. And I want to talk about why the market could still potentially keep going higher. Now, a lot of people look at the Russell 2000 to be a leading indicator. After we got our five-wave structure to the downside, you typically get at least an ABC correction. Now, the analysis is following pretty well here for IWM. We got an A wave up, and we pulled back for a B wave exactly to the 61.8% retracement level, right at the top of this gap here. And so it really wouldn't surprise me if we do get a bounce here, okay? And potentially we could even try to take out these highs. Now, the C wave doesn't have to extend all the way this high, and it could just be, a fake out. We could just bounce up and then continue breaking through the lows, but that's what we use our fib levels for, right? To see, once you break through that 61.8% retracement level and flip that to resistance from support, then the odds of a 100% retracement back to those previous levels, those odds greatly increase, right? So I am watching this. This is one reason why I think the market could potentially still bounce, and why I'm not necessarily overly aggressive shorting the market at the moment. If we take a look at QQQ, okay, not even having to go by the inverse bump and run pattern, we have this trend line here, and look at what we did. We broke out and we came down and retested it, right? Now, will we continue heading higher from here? We'll have to see. Okay, 370.47 is going to be a pretty big level for me. If we open below there, or if we end up staying below there and flip that to resistance, then I do think we can head down lower. But there's also strong support at 367.25. Now, when you take a look at the IWM compared to the QQQ, you see we had the move up and then a retracement. We really haven't gotten any retracement. So QQQ can pull all the way back to 362 down to 354.81, and it's still a healthy retracement, right? And that would take us to our 61.8% retracement level here if we were to pull back somewhere around this level. And look what that also ends up forming, right? It forms a left shoulder ahead, and then if we pull back towards the 61.8, that forms a right shoulder. So that'll be something that I'll be looking at for a potential setup if we do get a strong pullback, is can we end up getting that inverse head and shoulders to form here, and will that be a really good entry potentially for the next move higher? This is that inverse bump and run pattern. The bump and runs are one of my favorite chart patterns of 2023. I started using them in the beginning of the year, and they've been really nice to me from then. But you see you have a leading trend, right? So in this case, it's a downtrend, and then you have this aggressive bump down in the price. But once you break that first initial trend line, you see we have a very strong push up towards the second trend line. And the way the pattern works is you still could actually continue going even higher. And so take a look at what we had, right? We had our leading downtrend, then we had the aggressive bump down in price. We broke through, came to the second trend line, and now we're retesting that. It's very possible we could continue pushing higher. We'll have to see if this is a look above and fail, aka a false breakout, right here. And if we start trading back below in this range, that's going to be a little bit more of a bearish indicator. If we stay below this trend line, that we could potentially come back down to try to fill this gap here on the Qs. Now, what else can we use to really dive into the market? Well, I'll let you guys know that, but as always, the content provided on this channel is just for informational and educational purposes only, and it's not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. And the first thing we'll look at is TLT as a leading indicator, okay? TLT has been a really good leading indicator for a long time. And what do you mean by that, right? What do I mean by that? Well, if you take a look here, TLT is making lower highs while the S&P 500 is making higher highs. So this is a leading indicator basically saying that the S&P should be due for a little bit of a pullback, right? And sure enough, we end up getting that pullback. Same thing happens over here. Higher highs on the S&P, lower highs on the TLT indicates S&P should be due for a little bit of a pullback. And we start to see this divergence play out on smaller time frames as well. And most recently, I highlighted, before that really large rally last week, over the weekend, I put out a video saying, hey, if TLT is going to be a leading indicator, we're seeing the TLT rising here while the S&P is continuing to make lower lows. That could be an indicator that the S&P is due for a bounce. And sure enough, we got that bounce. Now for the NASDAQ, you want to use something like the TIPS. Okay, the TIPS is also going to be a leading indicator. You can see the TIP ETF here, lower highs, higher highs on the QQQ. And we're due for a pullback, right? And most recently, again, we were seeing higher lows on the TIPS and we're seeing lower lows on the NASDAQ, the NDX right here. And that suggests that we were due for a little bit of a bounce and a rally to the upside. You can also use the dollar, right? The dollar has been a really good indicator for the stock market. And these two basically have been trading in inverse ever since 2022. All right. You can see the S&P 500 in a clear downtrend here as the dollar is in a clear uptrend. And then the dollar really started this downtrend here. It's not a coincidence that the stock market bottomed at the same time that the dollar peaked in last year of October of 2022. And since then, we saw the S&P go on a huge rally. We saw the dollar decline. And now we've seen this increase in the dollar and we've seen strength in the dollar. And what do we see? Well, we see weakness in the stock market. So currently right now, we see on a shorter term basis, the stock market's starting to roll over and the dollar is starting to rebound again. So the big question is, will this uptrend continue in the dollar and will it just be choppy? Or if we actually start a downtrend and start putting in lower highs on the dollar, that could be, a sign of strength for the stock market. So you want to keep paying attention to the dollar and the S&P 500. You can also look at credit spreads. So we have the S&P 500 on the top here. We've got a credit spread ratio here of HYG divided by IEI. And so again, you can see here, when the credit spreads are making these lower lows and the S&P is making these higher highs, it's an indicator we could be due for a drop, right? And we haven't really seen a divergence up until late. The last divergence we saw was in August. And, we could see that ended up playing out here as well. And so this is just another thing we're going to monitor. We currently don't see a divergence, but this is something that you want to pay attention to give yourself that edge, right? And to be one of the things that you can look for as a leading indicator. Now, transportations, okay, the Dow Jones Transportation is also going to be a leading indicator. We won't dive too much into the Dow Jones Transportation theory, but we'll break down how it's a leading indicator here real quick. So we have the industrials on top, we have the S&P on the bottom, and then we've got our transportation right here. And you can see that the Dow Jones Transportation average topped before the industrials and before the S&P 500 topped before the bear market of 2022 started. Now, it also bottomed here before the industrials and before the S&P 500 bottomed in October of 2022. And if you take a look here, it broke major support. All right, that's what this yellow line is and this vertical line symbolizes. It broke its major support before the industrials and before the S&P 500 broke their support. So right now, what we're looking for is, will it be a leading indicator again, and can it break out? And then we see, a strong breakout in the Dow Jones Industrials as well as the S&P 500, right? Right now, it's rejecting. And if it's going to continue rejecting and heading lower, that could be a leading indicator that the stock market and the industrials are going to continue heading lower too. So I'll be watching the Dow Jones Transportation. This is the four pillars right here. The four pillars are pretty much the four sectors and subsectors of the market that you need to see in confluence, all right, and basically moving the same direction to see the stock market follow in the same way. So basically, if you want to see a strong rally and not something that's a fake out rally, you want to see all four of these going up in the same direction. We have XLK, which is tech on the top left, and then we have SMH right here on the right, which is basically arguably one of the most important subsectors of the tech sector. And then we have XLI right here, and we have XHB. Okay, so we have industrials, and then home builders is, again, arguably one of the most important subsectors of the industrials. And so, what we're seeing here is we're seeing that 2 out of 4 of these, okay, really actually 3 out of 4 of these have broken their downtrend lines, right? We saw the home builders sell off aggressively, broke their downtrend line. We see semiconductors trying to break their trend line right here, not necessarily holding it at the moment, but still trying to break out. And then we have tech breaking out. Meanwhile, industrials are lagging behind. So I think that paying attention to the Dow Jones Transportation and something like XLI or the Dow Jones Industrial Average is going to be really helpful for spotting, where the next move is going to be in the market. Now, so we have 3 of 4 of these breaking out, okay, trying to break out. And we have basically 2 out of 4 of them are still below key support, right? So, we had the home builders and we have the industrials here. They had their key support, and we mentioned as soon as one of these or multiple of these break through their key support, we're going to see continued downtrend in the market, and that's exactly what we got. So if you're looking for things to go bullish, you really need to see home builders and industrials start to rally, get back above that main support there. You want to see the industrials break out above its trend line and also get back above that support. And then you want to see continued strength in the semiconductors and in tech at the moment. Now, if you're new to the channel, I actually started a completely free newsletter for you guys. It's called Investment Intelligence, giving out free valuable content as well as free trade ideas. And this is what some of the trade ideas will look like, highlighting some of the conditions, showing you the chart. And you can see how, many of these trade ideas have worked out, right? This was another one on home builders 2 months ago, talking about the bearish conditions in the home builder ETFs as well as individual stocks. And you can see that the home builders dropped over 18.5%. This is a rising wedge on SWK, Stanley Black & Decker, highlighting, the price targets we think he could come down to on the downside. That also played out very well. So, if you're fans of free valuable content and you like free trade ideas and you want to get those straight to your inbox, make sure to sign up for that newsletter. If you want to join the Investment Intelligence Discord, where you get access to all of the different trade ideas and the different charts that I'm looking at, as well as much more, you can use the link in the description as well to sign up for the Investment Intelligence Discord. In the Discord, every single chart that we've went over today is actually available to you guys in there, right? So all these different leading indicators, the 4 pillars, and the many other things I'm going to go in, they're actually saved and shared with the Discord members under the flexible grids tab. And you can come in here and you can look at the market internals. You can look at the 4 pillars, the TLT SPX, the TIP NDX. All of those things that we're going over in today's video is actually available to you. So you don't have to do any of the hard work. You can just click on the script and it'll be imported into your Thinkorswim. Now, this is the daily chart for the 4 pillars. And, we can see here a little bit cleaner, right? The strength in XLK and the strength in semiconductors. XHB had a gap really far down to fill at 70, came down and filled that. And we had industrials had a gap down to fill at 98, came down and filled that, right? It was much lower than their support levels. SMH and XLK, if these things break through their support levels, you need to be really cautious of XLK coming down to 155. Of SMH coming down to 130. Okay, those are going to be some scary levels if we break our major support levels here of 142.59 on SMH and 162.69 on XLK. This is a percentage of stocks above their moving averages. This is also something I like to use as a leading indicator, especially whenever we see divergences. So we have the S&P 500 on the top here. We have the percentage of stocks above their 200-day moving average, and then the percentage of stocks above their 50-day moving average. Oftentimes when they get to these extreme conditions here, as highlighted by the gray boxes, or when there's divergences, these can be good buy signals, right? And so, or buy or sell signals, just depending, right? And so what do we see here back in October of 2022? We saw the S&P making new lows. We saw the percentage of stocks above their 200-day and 50-day moving average actually making higher lows. So there was a bullish divergence, and that actually marked the stock market bottom for the S&P 500. Most recently, we had a divergence where we were creating these lower lows. And on the 50-day percentage of stocks above their 50-day moving average, not only was it below 10%, extremely oversold, but we actually saw a bullish divergence here where we're creating those higher lows. Now, to get a sustained rally and to see true strength in the market, you need both of these to be above 50%, right? So you need, the percentage of stocks trading above their 50-day moving average and their 200-day moving average generally to be 50% or higher. And I mean, that kind of makes sense, right? If the market's rallying, then half of the stocks should be above, their moving averages, indicating somewhat of a bullish trend. Seasonality is another thing that a lot of people talk about. So we have the S&P right here in white, and then we have the seasonality projection here in purple. It's been following pretty well so far for the entire year, except for this most recent period we had here, right, where we saw an extended pullback in the S&P, where we were looking for actually the pullback and then a little bit of a rally. So the question is now, if you take a look here, we're basically at that point where we come in and make those new highs, and then we start to downtrend a little bit and then get another rally here at the end of December. right? That's the big question is, did we already come up and hit our peak, right? And following that seasonality, are we due to continue heading downwards and then rally towards the end of the year in December? Or can we actually extend this rally? And maybe since, the pullback was extended longer than it was supposed to be, maybe this rally could potentially extend longer than it was supposed to be as well. I know a lot of people are fans of seasonality. This is risk on versus risk off. So we have a risk on ETF that I created up here, composed of copper, high yield bonds, Aussie dollars, semiconductors, high beta stocks. And then we have a risk off ETF right here that is gold, US Treasury bonds, the yen, utilities, staples. And then we have the S&P right here. We talked about in the last video how we're starting to see actually a tick up in the risk on ETF. And we did basically if we're going to continue seeing that, we would expect to see the risk off ETF actually roll over, right? And so this was a textbook look above and fail, right? Buyers stepped in, pushed price higher, buyers were absent, sellers came in at the opportunity for buyers to push price higher and actually drove it lower, back below that trend line. So the market is and has been going more risk on. But notice how this is starting to roll over a little bit, right? So if this rolls back over, then that's not going to be a good look for the S&P. And there's a reason that the S&P hasn't broken its overall downtrend, is because we're not really seeing much clarity if the market is risk on or if the market is risk off. Both of these look like they're tried to break out, right? But we're not really seeing a strong breakout or a continued push in either risk off or risk on. If we take a look some more and we want to see basically the Magnificent Seven held the market up, not only for most of the year, but most recently, if we take a look, okay, this is where the rest of the market peaked, right? So what we're looking at is the Magnificent Seven on the top here, and then we have the other 493 stocks in the S&P 500 in white down here below. And so you can see that these actually peaked before the S&P 500 peaked, and those started rolling over before the rest of the Magnificent Seven started rolling over. And, basically just wanted to emphasize that the Magnificent Seven held the market up through that extended rally that we had. Meanwhile, the rest of the market was already starting to roll over a little bit and starting to pull back. If we take a look at the inverse 10-year yield versus the S&P 500, we have the inverse 10-year yield in white, and then we've got, the S&P 500 or the S&P 500 in white, and then the inverse 10-year yield in these candlesticks here. So basically what this is saying is that, if this is going down, right, this means that 10-year treasury yields are going up. And so basically what we're just emphasizing here is that the stock market typically goes with the opposite of the 10-year treasury yield. So if we're seeing the yields go down, then we're typically seeing the stock market go up, right? So as this is going up, this means that treasury yields are going down. And you can see how well this has followed it really over the past year, except for this one period through April and basically July, right? Right before we get into August. This was a period here where they were moving separately from each other. And so the 10-year yield was going higher, and also the S&P 500 was going higher. But typically, we're going to see the 10-year yield go down, and we're going to see the stock market go up with it, right? And so that's why we have an inverse 10-year yield versus the S&P 500 year. This is another thing you're going to want to watch and maintain. This relationship works pretty well with gold as well. So gold typically moves, the opposite of the 10-year yield. And so we can see here, as the 10-year yield is going up, meaning that the inverse chart is going down, that's whenever you're seeing the price of gold here. And so these things tend to follow. These are pretty good charts. Again, all of these charts are actually available to you guys in the Discord under the flexible grids tab. We have defensive versus offensive here. So we have high beta versus low volatility stocks. These are ratios. We have consumer discretionary to consumer staples. We've got a credit spread ratio here and biotech. And so you can look at these and see, if the market's going offensive or defensive, it's basically another risk on or risk off measurement. And we can see here, 4 out of 4 are in a downtick so far this week, right? Downtick in the high beta, low volatility, downtick in discretionary to staples, downtick in credit spreads, and downtick in biotech. We took a look and we saw that the other 493 stocks in the S&P minus the Magnificent Seven are also rolling over. So, there's lots of bearish signs here, but it's not completely over for the bulls. It's more just a lot of signs that, hey, we rallied really hard and really fast. And so it makes sense for us to get a pullback, but that doesn't mean that things can't continue going higher. The market can remain irrational longer than you guys can remain liquid. And as long as you remember that, then you'll remember not to, overly aggressive, play the market, whether it's up or down, whether it's long or short. You want to wait for clarity, and, you can wait for things to be a little bit more clear, and then you can play more confidently and have higher quality setups in your positions and in your trades. If you enjoyed today's video and you want a one-on-one personal session, a coaching session with me, you can go to my Ko-Fi page. There's a link in the description for that as well. Click on the commissions tab, and there you can book a 30-minute or 1-hour personal session. You can also request a YouTube video on the topic of your choice, or you can click on this buy a coffee button. It's basically a way to leave a tip or donation for all the free valuable content I put out for you guys. Don't forget to sign up for the newsletter too. Okay, that's completely free, giving out 1 to 2 free trade ideas a week. And those newsletter trade ideas, they hit, guys. They hit hard. The last two were Roblox. Okay, talking about Roblox going up, cup and handle, and then the one after that was ARM, talking about a false breakout, and saying how we think it was going to come down and fill its gap down. Earnings happened this week, and it came down and filled that gap down. That was a really juicy play there as well. So I appreciate y'all watching the video. Smash the like button, subscribe for more.